September 2008, Lehman Brothers filed for bankruptcy on a Monday morning. By Friday, $10 trillion in global wealth had evaporated. Pension funds collapsed, mortgage markets froze, and banks stopped lending to each other overnight. In a trading room in Midtown Manhattan, a hedge fund manager named John Paulson was looking at a $15 billion profit, not despite the crash, but because of it. The instruments he used didn't show up on mainstream financial television. Most individual investors have never heard of them. The conventional wisdom says that when the economy crashes, you protect capital by going to cash or gold and waiting to survive. That thinking is exactly why ordinary investors lose twice, once in the crash and once in the recovery. Crashes don't destroy wealth, they transfer it. This transfer always happens through the same 5 specific channels. The first asset is long-duration sovereign bonds. Most people treat bonds like dental appointments. They know they should have them, but they don't fully understand them. This is a catastrophic misunderstanding of how they behave during a collapse. When an economy deteriorates, central banks slash interest rates hard and fast. In 2008, the Federal Reserve cut rates from 5.25% to effectively zero in 14 months. When rates fall, existing bonds with higher fixed rates become extraordinarily valuable. While the S&P 500 fell 38% in 2008, the 20-year Treasury bond ETF, ticker TLT, gained over 33%. Even during the Great Depression, long-term U.S. government bonds returned positive gains for 4 consecutive years, while the stock market lost 89% of its value. Capital flees equity risk and floods into sovereign debt, pushing prices up with extraordinary velocity. The second asset is volatility. This is perhaps the most explosive instrument available during a collapse. The VIX measures fear in the options market. When markets are calm, the VIX sits around 12 to 15. During a genuine crash, it explodes. In February 2020, the VIX was 14. By mid-March, it hit 85, a 500% increase in 6 weeks. You can own volatility through exchange-traded products like VXX or UVXY. The reason financial advisors rarely mention these is that they decay in value during calm markets, a feature called contango bleed. However, institutional traders use them surgically. John Paulson's legendary trade was essentially a bet that volatility would explode in the mortgage market. Volatility isn't just an indicator, it's an asset class that moves inverse to the market with built-in leverage. The third asset is distressed debt. The most consistent creators of generational wealth during collapses are often credit investors who buy debt that panicking sellers have priced at a fraction of its recovery value. When credit markets seize, banks and hedge funds facing insolvency become forced sellers. They will sell a bond with a 90-cent recovery value for 30 cents just to survive. In March 2020, investment-grade corporate bonds fell nearly 20% in 3 weeks due to forced selling, not rational analysis. They recovered to new highs within months. Institutional legends like Howard Marks of Oaktree Capital have built empires by buying what panic prices as if civilization is ending. The trade is buying when high-yield credit spreads widen to levels that imply the entire economy is insolvent, a scenario that rarely happens in a modern economy with a functioning central bank. The fourth asset is gold, but not for the reason most people think. Many believe you buy gold to hedge the initial crash. In reality, gold falls during the first phase of a crisis as investors sell everything to cover margin calls. In 2008, gold fell 28% during the height of the crisis. The real fortune is made because gold protects against the government's response to the crash, the massive money printing and rate cuts. From its 2008 low, gold rose over 160% by 2011. When the monetary base expands rapidly, gold appreciates proportionally to that expansion. The lesson is to buy gold when central banks begin their response, when real interest rates turn negative and the political pressure to print becomes irresistible. It isn't insurance against the crash, it's a bet on government desperation. The fifth asset is agricultural land. Between 2007 and 2012, while U.S. home prices fell 26% and stocks were cut in half, Iowa farmland values rose by over 100%. Farmland is a productive asset that generates output independent of the financial system. A soybean field does not care if a major bank is solvent. It produces food, and people must eat regardless of the bond market. During financial stress, food security becomes a premium concern, and supply chains fracture, causing food prices to spike. Farmland is uniquely orthogonal to the financial system. While bonds require central banks and distressed debt require legal systems, farmland only requires soil, water, and biology. It is perhaps the most durable form of productive capital in existence. Every economic crash in the last century confirms that money lost is simply money changing hands. It moves from the reactive to the structural. These 5 channels, long-duration bonds, volatility, distressed debt, gold, and agricultural land, are the paths that wealth takes during a crisis. The difference between those who are destroyed by a crash and those who are positioned for it isn't intelligence, it is preparation. The question is never whether the next crash is coming, but which side of the wealth transfer you will be on when it arrives. Underneath the headlines, the patterns are always there for those who know where to look.